Hello, everybody. This is Steve Bouchey. Welcome to our second webinar. Hopefully you'll enjoy today's presentation as much as for those of you that were on the first presentation with Ryan and I a few weeks back. You'll enjoy it as well. These are webinars that we plan on doing regularly. That's a really nice way for us to bring you up to date with what we see is going on in the markets, give you some information in an easy manner. So I thank you for taking time out of your day to be part of this. I can't see you, but I know you're there. So today, Marty and Ryan will be doing the presentation, and at this point, I'd like to hand it off to Ryan. Enjoy the presentation, and thank you for being part of it.
All right, thank you, and welcome everybody. So before I get into it, I just want to remind everyone, we did take a lot of feedback from the first webinar we did. We understand some of the slides may be hard to see and get all the detail on during the presentation, but we're going to upload everything next week to our website, and we'll send out an email notification with that. So you'll be able to see the recording, and we'll also put up the PDF version of the presentation so that you can really look at the detail of the slides. And as always, if you ever have any questions or want to go through anything again, please feel free to our team. So with that, we have the equity market divergences, really driven a lot by these tariff headlines. So let's look at the second quarter recap, and you can really see how different indices and different asset classes have started to diverge in this past quarter. If you remember from the first quarter, everything was sort of in line, sort of looked like the beginning of the second quarter where you see those charts really line up together. But about end of April, beginning of May, you really see some divergences. So the NASDAQ, really driven by growth technology companies, up close to 10%. The S&P, that middle mark, up around 5% for the quarter. And international developed we have here down for the quarter about 1.2%. So you're seeing the divergences, and what Marty and I want to do today is really get into the reasoning behind these divergences. So here we go. We have the different asset classes that we're looking at: the large cap equities, small cap equities, international developed, and international emerging markets. And you can see second quarter, large caps did fairly well, up about 3.5%. Small caps really well, and again, mainly driven by some of the tariff headlines. You can imagine smaller companies aren't going to have as much of an impact by global trade, so they've actually did a little bit better than U.S. large caps. And then you see the divergence with international markets. You see developed international down a little bit for the quarter. In emerging markets, really down for the quarter, down about 8%. So you're really seeing some spread there. Again, we're going to get into what's causing this divergence, but when you go back to the end of the first quarter, if you remember, emerging markets were actually the only asset class that were up for the quarter. And you go back, and I put into the right side of this slide, 2017, you see really some of the strength in international. And so we want to be cognizant of what's driving some of the volatility in seeing what happened in the second quarter. But we have to keep in mind that we're making decisions for longer than a 2-3 month window, and we're going to get into what we're seeing in the markets and what's driving these different returns. And then on the bottom of the chart, again, U.S. bonds down for the quarter, down for the year, and that's another area of discussion that we want to get into on today's webinar. So what are we doing? What have we been doing in the managed portfolios? So if we've been talking individually or hearing from our last webinar or State of the Economy, in our portfolios, we're overweight equities relative to our benchmark. We've been that way since going back to last year. We're overweight U.S. equities versus international equities. We do hold international equities, but if you look at our benchmark, we are definitely overweight U.S. equities relative to what we're measuring against. Some of the sectors that we're overweight, we continue to be overweight technology. That's been really the leading sector in the market this year to date, last quarter. Financials, we continue to be overweight. Financials have had struggles on the large cap side, but we are also invested in those small and mid cap banks, which with a rising interest rate environment, been doing very well. We added to healthcare and biotech earlier in the year. We added to online retail, two areas that are both doing well versus the S&P. Those two sectors are up. We added to small caps at the beginning of the year. Again, some of the reason being the trade war fears and having less of an impact. and with our overweight to technology, we're overweight those growth elements of the U.S. equity market. What are we underweight? Well, if we're overweight equities, we're underweight bonds, we're underweight international equities. Again, even though we hold them, we're underweight from a benchmark perspective. And then some areas of sector underweights, utilities, telecom, they drive a lot of their earning and value through their dividend. We wanted to be underweight with a rising interest rate environment, and we're happy with that. We're underweight consumer staples, and we're underweight value. And again, we can always go through that individually on your portfolio to see where those weightings come from. So we want to talk, to begin, really two major headwinds we're seeing in the market. One being the trade wars in some of the talks of the tariffs, and the other one being rising interest rate environment. So I'm going to start with trade wars heating up. And so let's look at some of the areas of the global economy that maybe are less at risk from a global trade war. And we're looking at exports as a percentage of GDP for these countries. So you can see U.S. as a percent of their overall GDP, exports make up only 8%. That's a really, really low number. You look at Japan a little bit more, 14%, the Eurozone at 16%, and the highest of these developed countries, Canada, at about 25% of their GDP made up of exports. So, when you look at the U.S., we're a little bit more insulated from some of these tariff talks and trade war talks, being that because so much less of our GDP is driven by exports, we're not as worried with the U.S. market as and that's probably another reason why you're seeing the U.S. market do a little bit better than some of the international markets. And then we go to the next slide, and you see some of these areas of the world that are most at risk. And when you look at this slide, it's a lot of emerging market countries, and that's a big reason why you're seeing that divergence this last quarter, is that more of these emerging market countries make up more of their GDP from exports, and so they're going to be impacted more than the U.S. would be if this trade war escalates and we get into any more tariffs with other countries, and as other countries get involved and pulled into it, you can see how these countries may be impacted more than the U.S. or developed international. So this is, really paints a picture of why you're seeing more volatility in this side of the market right now. And again, is this being used as a negotiation tactic? Is it going to be long-standing? It's really hard to say, and that's why we sort of continue to be, not overreact to what's going on right now, but also being very cognizant of what's happening. And just real quick on this last slide with global trade, you see U.S. dependence on China has been dropping over time. It was growing for a while in the 2000 to 2005 period through 2009, but it's been leveling off a little bit, and we just want to show again, being less dependent on China. And I think as a percentage of our GDP, less than 1% of exports are going to China. So as a whole, we're not as worried from the full economy of the U.S., but certainly segments of the U.S. market that are going to be impacted. The farmers, you saw a soybean cargo boat trying to get to China before tariff took place last Friday. Manufacturing, steel manufacturers maybe not so much, but those manufacturing companies that are working with steel are going to be greatly impacted because costs are going up with that. So those are the areas of the market that may be impacted, but we think as a whole, it shouldn't be as big of an impact. And again, that's why we're not overreacting to the news that's coming out and as trade tariffs go into place. And let's look at that second headwind I talked about, and that's going to be the impact of the Fed raising interest rates. I mean, they've already been doing so for a number of years, and we've already had 2 rate hikes this year, possibility of 2 more going forward. So what does that mean, and what are we looking at right now? Well, I think one of the big topics that's been in the news lately has been talk of the flattening yield curve and even the potential of an inverted yield curve. So, we're just going to show this chart here where you look on the left side, that vertical axis is the interest rates, the horizontal x-axis on the bottom is the different treasury notes, treasury bonds from the U.S. government. You can see 3-month all the way to 30-year on the far right side. In that gray dotted line in this chart, that's what the yield curve looked like 5 years ago. That's more of a, probably a normal looking yield curve in terms of, big dispersions from, a 3-month, 1-year U.S. government bond versus a 10-year and even a 30-year. When you look at that blue line that looks a lot flatter, that's what we're dealing with right now with that flattening yield curve. You see the 10-year Treasury note at about 2.9%, the 2-year at about 2.6%, and those fluctuate on a day-to-day basis. They've even gotten a little bit closer, and so that's what we mean. And when you hear in the market news and market commentators talking about a flattening yield curve, you can see it right here with this chart, and all it means is that those interest rates are compressing and getting closer to each other. Now, the big topic that everyone's talking about is, all right, with that flattening yield curve, or again, a potential for an inverted yield curve, you go back over the last 40 years or so, it's actually been a pretty good indicator of future recession or a future bear market. And so when you look at this, again, you're seeing where it inverts, it goes below zero on the middle of that x-axis. And typically over these last 40 years and those last 5 recessions, it takes about 18 months for the recession to hit when the 10-year and 2-year note invert, and about 21 months for a bear market to begin. So, is this something we're looking at and considering as we're making investment decisions? Absolutely. Do we think that because it's gotten flatter and getting closer to inverted, we're headed for an immediate, either recession or bear market? We don't think that, and Marty's going to get into some of our thoughts on the U.S. economy and the markets and where we see that playing out. One area that I really want to focus in on with the talk of the inverted yield curve is look at the yellow line, which is showing the compression, the 10-year and the 2-year getting closer and closer, and when it gets to zero, that would be an inverted yield curve. But that white line, what that signals is major foreign governments, their purchasing of U.S. government debt. And so we're seeing a flattening yield curve, but what's causing that? Is it caused because our economy is slowing down? We don't think so. The economy continues to get stronger, but shorter term rates are going up with the Fed. Why are those longer term rates, specifically the 10-year note, staying, relatively flat and not really going up as much as the shorter term yields? Well, a big reason is foreign purchasing of these bonds. And, even going back to 2007, the rate that they're purchasing is about 4 times as much as they were, only 9-10 years ago. And if you go back to 2001, in that last time we had a market bubble, they were purchasing, barely 10% of what they're doing now. This is a big reason why we feel the yield curve is flattening like it is. It doesn't mean, again, that there isn't future concern for a recession or a bear market, but we have to keep in mind what's driving the flattening yield curve. And we think that foreign purchasing of these government debts is a big reason why that 10-year and 30-year are staying low, not so much that people are as worried about the economy going on right now. And so just the last slide I want to get into is, with the rising interest rate environment, obviously I'm sure if you look at your portfolio, bonds are not doing well. We looked at, the Barclays U.S. aggregate, how it was doing so far this year, and bonds are down a little bit this year. And that can be frustrating, it can be concerning, but let's remember the role that bonds and fixed income play in a portfolio. We are still encouraged and optimistic of where the market is right now, and again, Marty's going to get into that next. But we don't know if there could be something on the horizon that, causes a short-term drop in the market or short-term volatility. And bonds are there to act as that counterbalance to equity. So even though it's frustrating in the short term, so far year to date, the bond aggregate is down for the year, we have to remember why they're in the portfolio. And they play a very specific role. And for those savers and retirees who are invested in bonds, in the short term, yeah, we're seeing a little volatility, but as rates go up, that's going to be a good. If you're a long-term investor, these things are going to play out as rates increase. So, again, it can be frustrating, but when you look at this chart, that green line is a full S&P 500. You see how far that dropped. Just having, a 60-40 portfolio, not only does that help the amount that it drops, during a crisis like 2009, but also it helps increase the time that you recover those assets. So again, try not to be too frustrated with where fixed income is. There's a very specific role and purpose for them in a portfolio. And with that, I'm going to turn it over to Marty Shields.
Thank you, Brian. Good afternoon, everyone. What I want to talk about is whether or not this bull market is in place, meaning that we're coming on 10 years in March of next year. And do we see this continuing for the rest of this year and for the next two? And as we talk about, we're constantly looking at what is going on from an economic perspective and where do we stand in this business cycle and market cycle. So I'm going to go through and talk a little bit about what we're seeing and how it's driving our investment strategy. So one of the things we're always talking about is valuations, right? So if you're going to be buying into equities, are you buying in at a good price and you're holding at a good price? Because at some point, if equities become too expensive, there's a better chance that you could see a market decline. And this chart basically shows you what valuations have been since 1990. That's the gray line. And the green dotted lines are kind of the bands. And that middle one is the average valuation for equities. So it's the term PE, price to earnings ratio. So what are you paying for $1 of earnings? And what you can see is the average PE is around 16. And during the tech boom, we went way over the average and even above what's called one standard deviation, or the highest band, all the way up to a PE of around 24. So a real dramatic change where stocks became very expensive. And if you look at 2009 and 2011, stocks were inexpensive. And in general, again, you want to be buying low and selling high. Now, in the last year or two, valuations started to move up above average. But this past quarter, in particular with the tax reform bill that went in place and corporate taxes going down from changing from 35% to 21%, you can see now that we're actually right at the historical average of 16.1%. So from a valuation perspective, it doesn't drive everything, but it does show you that we're in a very reasonable valuation for equities right now. The other thing we want to look at is GDP, or gross domestic product growth. And really, again, when you think about it, the stock market is based on corporate cash flow, future cash flows, and in large part that is driven by the ability for the economy to continue to grow. And what this chart looks at is GDP growth, year-over-year change, all the way back to 1970. And the gray bars actually show that change. You can see, and for the most part, it's positive. There are times where you have recessions, where you have economic decline. And then the blue dotted line is the average GDP growth, which is 2.7%. Then if you look over the far right-hand side, there's a second dotted blue line, and that has been the GDP growth since this business cycle expansion in March of 2009. And what you can see is it's been averaging around 2.2%, right? So you may have heard the term new normal. And what that means is that, relatively speaking, for this expansion, GDP growth has been below average, below the 2.7%. And now it's just in the last quarter or so where we're starting to reach that average. The gray bar starting to move up to that average kind of recovery times. We're well below what we've seen in other recovery times. And that is a big part of what this economic recovery has been about, right? It actually has been a fairly long economic recovery from when you look at the number of months. But when you look at the actual growth from where we were, which is a very low, to where we've come, it's been a very slow growth from GDP growth. And I think that's important. And what that means to us is this business cycle can continue to go on much longer than others because you have not had dramatic GDP growth like you usually have had in other recoveries. And we're just starting to get back to an average GDP growth. Again, one of the other factors that we're looking at is wage growth, and we talk about this quite a bit, right? So as the economy gets better, workers are able to earn more, which is a good thing because that drives consumer consumption, and the consumer makes up around 75% of the U.S. economy. But it's a kind of give and take, right? So if the wage growth becomes too strong, it increases inflation and it eats into corporate profits. And what you see is, if you look back at the last 3 recessions, it's not until wage growth hits 4%. So that's the blue line that you see, and the gray bars are economic recessions. And you can see with the arrows that right before those economic recessions, you see that wage growth is up at or above 4%. And we're still in the mid 2% range. So what this means is workers are earning more, and again, that's a good thing, but as it increases, it's in a very slow fashion. So this also allows the Fed not to have to raise rates too quickly. So again, from an indicator perspective, this says to us that the economy has continued room to grow, and wages have the ability to move up before they become a problem as far as wage growth. The next slide shows consumer consumption basically through retail sales. And what you're looking at, the green bars show growth in retail sales. The red bars, which is just a few of them, are when retail sales actually decline. And what you can see is of the last few quarters, we've had few months, we've had strong consumer retail sales. And again, with the consumer making up 75% of the U.S. economy, and with strong labor markets, low unemployment, wage growth, we expect this to continue. And we've talked about this before. The consumer actually, relatively speaking, has not taken on too much debt, which they did back in 06 and 07. Relatively speaking, the amount of debt they have is very reasonable from a historical perspective. So they're in a good position to keep spending via retail sales. So this next chart is very important, very telling. What this is looking at is S&P 500 year-over-year earnings growth, right? So again, the stock market moves up because corporations are able to increase their earnings, their cash flow. And they do this really by 2 major ways, either by managing or cutting cost, so increasing margins, or increasing revenue. And what this chart looks at are those 2 components plus share count, which is really stock buyback. And basically, people have been concerned that a lot of this growth in corporate profit has been due to stock buyback. But what this chart indicates is not really the case. So the gray part of these bars is margin growth. So again, the ability for companies to control cost, and then the green is increasing revenue. And what you can see is in most of the quarterly growth, annual growth in earnings per share, it is due either through improving margins, and that's for the last quarter, the 26% year-over-year profit growth was mostly because of margins, and that's again mostly because of the tax reform bill. But it was also because companies were able to increase revenue 9.3%. But you can see that just a very small amount, just less than 1% of that 26% profit growth was due to stock buyback. And even when you look at other years, stock buyback do not make a big impact in the overall increases in earnings per share. And I think that's, again, important, that really the growth that we're seeing is because companies are able to increase revenue and manage their costs through productivity. So we want to talk a little bit about international, just to understand what our outlook is there. And in particular, as Ryan said, the past quarter has not been good for international, but it is only 1 quarter. And just to kind of give you a kind of understanding of why we have international and why we still think that it's a good place from a long-term investment perspective. This chart basically looks at the performance of the S&P 500, which is the gray bar, and it compares it to basically an all-world index without the U.S., and that's the purple bar. And what you can see is that over time, from 1997 up until around 2012, those 2 lines go fairly close with one another. I mean, at the very least, if it's not identical, it's in the same trending fashion. So when one's going up, the other one's going up. And what you can see is in 2012, there really is a divergence. International has been more or less flat since 2011, where the U.S. has done very well. And you can see that in also the valuation of these two different indices. So right now, as we mentioned, the PE ratio for U.S. equities is just over 16%, which is around its historical average, whereas internationally we're at 13, a PE of 13. So valuations look good, very good for international. And again, what usually happens is there are periods of time when one asset class outperforms the other. We could be in a period of time where international starts to outperform U.S. And this chart would indicate that that could be the case. Then we also want to look at earnings growth. And this next chart basically looks at earnings per share growth for the next 12 months. And the orange bar is emerging markets. The blue line is the U.S. and the green line is developed international. And what you can see is over the last number of months, earnings per share growth is very strong. And our expectation is that's going to continue. And again, it's really a reason to be overweight equities, but still feel comfortable with having allocations to international. This next graph or chart looks at the performance of the U.S. market and international markets, and then it also looks at the impact of currency. So if you look at under 2017, there's the performance of the markets in both the U.S. dollar and the local dollar. So what you can see is in 2017, the S&P 500 was up just over 21%. And then if you look at the local dollars, this is the performance of international markets. It ranged anywhere from 14% for the Europe ex-UK to 31% for emerging markets. So as Ryan mentioned, last year, international outperformed the U.S. But when you took into consideration how that got converted back into U.S. dollars, it was even more dramatic, right? So last year, the dollar declined and relative to other currency, and that added to its performance. So it went from 14% in the Europe ex-UK to a performance of 27%. And for emerging markets, it went from a performance of 31% in local dollars to a performance of almost 38% when it get converted to US dollars. Now, year to date, we're seeing really just a little bit of the opposite, right? So the S&P is up 2.6% year to date. International is underperforming. It is negative. But what you're seeing is that gets magnified a little bit because you have a strong US dollar. So it's important to understand kind of what is at play in your portfolio. The other thing to remember is, and we've discussed this before, we also have a position in your portfolio that hedges out the US dollar. And so that does not get impacted either positively or negatively by the changes in the currency. You're just getting the actual performance of those markets in that fund. This next graph basically looks at how the US dollar has done relative to other currencies since the mid-1970s. And what you can see is the gray bar is the actual performance, and the purple bar is the trend that you're seeing with the dollar relative to these other currencies. And what you see is there's a lot of up and down. And it's very difficult to determine which way the dollar is going to go relative to other currencies. It's easy to get that wrong, and that's why we use both a hedge fund where the dollar is removed and other funds where it's not removed. So to say where the dollar is going to go as we move forward here is a very difficult prediction. The one thing that can happen, though, over time, and you can see this with other countries, is where a country has a lot of government debt, that is quite often the case that the value of that currency declines. You see that in Latin America with a lot of countries. We've seen it with Greece. And right now, one of the concerns that we have, more from a long-term perspective, is that the federal government's debt is continuing to increase. And one of the ramifications of that is the value of the US dollar could decline relative to other currencies. And what that would mean is investing internationally would actually be very beneficial with a weaker US dollar. So just something to consider as we look more long-term to the asset class and what is one of the ramifications of having increased government debt relative to GDP. So just to give you an idea, I think it's important to know as investors, what is the global market look like and relative to the US and from an investment perspective. So when we're looking at global GDP, the US makes up around 24% of the global GDP versus the rest of the world at 76%. And at $19.4 trillion, we're by far the largest economy. But one of the things that's happening is our share of the global GDP over time is actually starting to decline. You have countries like India and China and other emerging markets that are growing their economy, and at some point, China will overtake us as the largest economy. So this ratio is going to continue to decline with the U.S. allocation of total GDP. And then when you look at the total market of global stocks and bonds, we're at around 36%. So the majority of stocks and bonds in the global market is actually outside of the U.S. And then if you look at the average U.S. investor, which is based on current fund flows and holdings, the average investor is around 30% having in international and 70% in the U.S. And as Ryan mentioned, we're actually below that. We have probably somewhere below 25% in international equities. So as Ryan mentioned, we're actually below our benchmark in our international allocation. So let's just, in the last slide here, talk about the reason and the importance of having international in the portfolio. So one of the most important ones is diversification. So like you have years like last year where international outperforms the US, but overall it lowers the volatility that exists in the portfolio, and overall it actually over time increases the performance of a diversified portfolio. But the other reason is demographics. So this slide basically looks at, in this case, it's 5 different emerging markets and what's happening with their demographics. And basically it's looking at the change in the middle class. Right, so the gray bar is the percentage of the population that is in the middle class in 1994 for these countries. The purple bar is the percentage as of 2017, and then light blue is what the expectation is for 2030. And what you can see is there's a dramatic change that's going on here of individuals moving from not being in the middle class, basically being in agriculture, and moving to urban areas and moving into the middle class. And what that means is, if you think about with the U.S., 75% of our economic growth, GDP, comes from the consumer. So as these countries change from being agrarian to becoming more middle class, the amount of consumption and increasing GDP will change dramatically as well. So by investing in these countries and even investing in other developed countries like Japan who sell into these countries, we're going to benefit as consumers. And you can see the change from 1994 to 2017 has been fairly dramatic, but the change from 2017 to 2030 is even more dramatic. So again, a real important reason to have allocations to international in your portfolio. Well, folks, that wraps up our webinar. Hopefully you found it to be beneficial. There were no questions that were sent in. But if you have any questions, certainly call in or email in, and we'd be more than happy to talk about things in general or any specifics regards to your portfolio. And we'll be, as Ryan mentioned, we'll be loading a PDF of the presentation onto our website and a copy of the webinar onto the website as well. So we want to thank you for joining, and have a great weekend.